Mark O'Brien is a bullion dealer, so in this interview he shares with us the demand from clientele, be it silver or gold, geographical position, and much more secretive details. With many of the Democrat states hating on Trump, political instability might trigger a precious metals bull market. Go to portfoliowealthglobal.com/bonds to learn about the greatest threat to your prosperity now.
Welcome to the Leaders of Tomorrow show at portfoliowealthglobal.com. My name is Michelle Holliday. Today we have a very interesting interview because our guest is the founder of a bullion dealership. So he will be able to give us a bird's eye view of how the precious metals industry reflects the sentiment of people worldwide. Our guest today is Mr. Mark O'Byrne. Mark is the founder of goldcore.com. The company is based in Ireland with clientele all over the world, including many American clients. The company's expertise is the protection of wealth through the investment and safe storage of precious metals, with clients in over 140 countries and sales of over $1 billion since its creation in 2003. Mark, welcome to the show. How are you today?
I'm great. Thanks, Michelle. Thanks for having me on.
Oh, this is amazing to have you here. Mark, looking at your company's sales internally for 2018 so far, would you say that individual investors are buying more gold or more silver?
Yeah, definitely more gold than silver, and that's been the way since the company was founded in 2003. There hasn't been one year where we saw more silver buying than gold buying. So it tends to be around 70%, 75% gold, 25%, 30% silver. And that's continued. It's actually even more so gold recently because, yes, I saw silver has underperformed and fell much more than gold fell in the recent bear market. And sentiment towards silver is even more depressed than it has been towards gold. And I also think that it's interesting, the demographics of the silver buyer, they tended to be a little bit younger than the gold clients, and they tended to be a little bit more about return rather than solely about preservation. So, and I think that type of buyer, a lot of them have actually started dipping their toe into the Bitcoin market and into the cryptocurrency market, because obviously that's where the volatility and the returns are. So I think, I don't want to exaggerate that, but I do think at the margin, some of the guys who would have been, and girls that would have been buying silver in recent years, are actually now more in the cryptocurrency market. So I think that's another reason why gold is seeing greater volumes on the gold side. And plus it's a function of, as I said, both markets have been quite depressed. They haven't performed great from a price point of view. Gold is more of a traditional safe haven asset, and that's where the demand is coming right now. It's from people who are looking to hedge the various risks in the world.
Now, numbers wise, Mark, please compare 2018 with recent years in terms of how precious metals are faring up on the demand side. And secondly, from your perspective, do you feel that President Trump's election inside the United States has changed the demand or the type of client that you're seeing?
I was supposed to ask your second question first, regards President Trump. Yeah, not so much. I think we expected it was, quite a shock when he got elected, and he's quite divisive, and people are either for him or against him, and there's very little middle ground. And he is, he's taken a huge amount of action, and he's done a lot of things, and and he's quite. Some of his policies are quite aggressive in terms of trade policies and economic policies and foreign policies. So we had expected that, and who's to know, that maybe, only time will tell, whether what he is doing have the effects that he hopes, and indeed his supporters will have for America and the American economy and the various challenges that America faces. But we thought that given he is a man of action, and he was going to do a lot of things that he said he would do on the campaign trail, that would result in more volatility in marketplaces and in risk assets in particular, in terms of stock markets. And I think a lot of analysts, including ourselves, were surprised how well the stocks have performed. And I think because stock markets have performed very well, and indeed the dollar has performed very well, the US economy is, I think, quite superficially, but I think the perception is the US economy is doing very well. And therefore, I think that has meant that gold has not done as well as people would have thought it would have done, So while the risks are there, it hasn't actually impacted the stock market markets in particular, and therefore risk appetite remains very high. There's very little risk aversion, and therefore gold hasn't seen a significant increase in demand. So, and then to your first question in terms of demand, it's the demand is I suppose we can break it down in terms of us as a company and what we're seeing, and then and the wider marketplace. But us as a company, we are busy, and we're seeing a lot of repeat business akin to what we saw in 2006, 2007 before the first financial crisis. A lot of the smart money who came in then are coming back to us now. There's very little new entrants into the gold market. We're not seeing, suddenly people who've never bought gold before open up accounts and buying gold. That hasn't happened just yet, and I don't think it will happen until gold prices go higher for a year or 2 years, and and gold gets into the headlines again, and there's a bit of positive sentiment towards gold. The people are buying gold again. It's people who are concerned about these risks. I think they're a little bit more risk averse, a little bit more aware of the risks that are there, and they're diversifying their portfolios and buying physical gold as a hedge and as a safe haven asset. So while we are busy, and 2018 is a good year, we've our client assets under management are assets that our clients store with us in some of the safest vaults in the world, in Switzerland, Singapore, Hong Kong. I think we're up over 25% for the year, which is quite strong, because when we look at a lot of our competitors, we keep an eye on all our major competitors, the likes of goldmoney.com, bullionvault.com, the ETFs. Most of them are essentially flat. They haven't increased their assets, including the Spider Gold ETF, which is the big gold ETF in New York, essentially flat. And I suppose that's also reflected when you look at the government mints and the data from the US Mint and the Royal Canadian Mint and the Perth Mint. They're showing that there hasn't been a huge amount of demand for gold or silver coins, particularly in the Western market, so in the UK and in the US. Where the big demand is coming from is, again, from Asia, from China and India, and these people are, gold is in their DNA, it's in their psyche. They
Right.
Yeah, exactly. It's just they just buy it. They understand that fundamentally it's just part of their daily lives. In effect, they don't see it as an investment. They just see it as money and a form of saving. So they're buying it, continue to buy it. And the Germans, interestingly enough, very big buyers on a per capita basis. I think the Germans are now the biggest buyers in the world. And the Germans, it's interesting because we're here in Ireland, and there's a perception in Ireland that, we have the euro, so we're safe in that regard. We don't have that risk of inflation or currency devaluation because we have the German currency, and we have the Bundesbank
Right.
and the ECB. But the Germans, interestingly enough, they're concerned because they see what's happening in Italy now, and the real risk of there's a political crisis in Italy, and there's a real risk of a financial crisis in Italy because Italy has a massive debt issue, both in the sovereign side of things and also in the banks in Italy. So, and Italy is much bigger than Greece. So the Germans are worried about Spain, Italy, Greece, Portugal, and Ireland to an extent, and they're buying gold in the big way because they're worried that the euro will be devalued in the coming months and years. So it's interesting. I mean, essentially, the Western markets have been more depressed in terms of demand for physical gold and indeed silver, but the Asian markets and the German market is where the demand has come in, and also the central banks. Actually, the central banks are net buyers now. And there's some very interesting developments on that side of things. The Russian central bank has been buying gold in a big way in recent months and years, and they've sold a lot of their US treasuries. And just in the last month or 2 months, Poland, a central bank in Europe, and indeed Hungary, a central bank in Europe, have bought gold. Hungary increased their gold reserves by 1,000%, so tenfold. I think they went from just over 3 tons to over 31 metric tons in 1 month.
Wow. What
Yeah,
accounts for that, Mark?
yeah, in 1 month. I think they are, I think, seeing the writing on the wall in terms of the risks posed to the eurozone, and the Italian debt crisis. I think could be the what ultimately there's Brexit there as well, obviously. So there's a lot of pressures on the EU itself, and indeed on the euro as the common currency of all these nations. And I think they're aware of these risks. And also now in Germany, there's a movement to the more populist parties on the left and on the right, a little bit like the movement towards Trump. People are disenfranchised, they're disenchanted with the mainstream politics, and they're moving to the left and the right. And the left-wing parties and right-wing parties tend to be more anti-European and indeed anti the euro and the single currency. And a lot of these movements are actually talking about taking power back in terms of their own central banks and having their own currencies. So I think the Hungarian central bank is I think they're aware of these risks. They're probably aware that the euro itself is quite vulnerable. They're possibly also aware that the dollar itself, given the debt position of the US, the dollar is likely to come under pressure in the coming months and years. So they are diversifying their foreign exchange reserves, and they bought gold in a big way last month. That news only broke last week. So I think the demand story for gold is actually quite positive, but it hasn't really been reflected in price just yet. It has a little bit in October. Gold is up 2% for the month of October. Meanwhile, stock markets are off very, very sharply indeed. I think the S&P 500 is down 7 or 8%, and most of the big stock markets around the world are off quite sharply in October. And gold is acting as a safe haven asset again, as it tends to do. It tends to have an inverse correlation with risk assets, So the fundamentals are very sound. There's no doubt about that, and I think the outlook is very good indeed.
Wonderful. Now, Mark, how many of your clients purchase actual physical gold in comparison to GLD ETF? And taking it one step further, do many of your clients actually invest in both forms of gold?
No, 100% of our clients buy physical gold. We actually don't have any clients. We don't actually offer the gold ETF. We did before, yeah. We had a wealth management division up until 2015, and then we sold the wealth management division. And in that wealth management division, basically was balanced portfolios. So they would have a balanced portfolio of maybe 40% in global stocks, 40% global bonds, and then they would have the 5-10% allocation in gold, and that would have been either in permanent certificates, the government of Western Australia, government certificates, gold government certificates, or it would have been in a safer form of ETF. But the wealth management division is gone, and so what we specialize in is, as you said, we're a bullion dealer, so we very much specialize on the physical side of things. And we're not anti the ETF per se, but we think the ETF is great for people who are more about speculating on whether gold is going to go up or go down, or taking a short-term punt. You can go long, go short with the ETF, and that's the value of it. But we don't think it's a great way to. The value of gold is that it's a proven hedging instrument and a proven safe haven asset that's been seen throughout history. And indeed, there's a huge amount of research in recent years showing how gold is a safe haven asset, both in academia and also with independent asset allocation experts, the likes of Mercer and Ibbotson and people like that, So that's physical. When you own an ETF, in effect, you own a form of, I suppose, electronic gold. You have an exposure to the gold price per se, but you don't own the underlying physical asset. And ETFs, yeah, in effect, you own a share in a trust that owns the physical gold. You don't own the physical gold, and there's a huge amount of intermediation and counterparty risk between you and your gold, including many banks who are custodians and sub-custodians of your gold. So to us, yeah, again, it's a great way to get exposure to the price, but it's not a great way to actually invest in and own gold.
So you prefer physical?
Absolutely, and we're very much about getting into your hand, and we actually deliver to people's houses and offices, and all over the States and all over the world. We have clients in over 140 countries, and it's not for everybody. You have to feel very secure in your own home before you do that, and we caution clients: listen, do not take delivery. If you're going to have sleepless nights about this in any way, then it's not for you. You should store it.
Right.
Yeah, you should store it. But some people are happy to do that, and if they are, absolutely. And a lot of people actually do a combination. They might take delivery of a very small amount and then store larger amounts with us, and that's very much what we specialize in, is secure storage in some of the safest vaults and the safest jurisdictions in the world.
Interesting. Now, Mark, is there any catalyst that you see coming in the near future, or are we still far away from gold becoming a raging bull market?
Yeah, there's so many catalysts, it's hard to know where to begin, and
Okay.
I think, yeah, there's a lot of financial, economic, political undercurrents. They're sort of bubbling away under the surface, and meanwhile the top of the volcano looks very benign, and people are walking around and having a good time and having a picnic, but underneath the surface there's a lot of very big issues that haven't been dealt with, and we think they're going to come home to roost in the coming months and years, and we think in time that will contribute to a raging bull market. Yeah, I think at the very least we'll see what we saw from 2001 to 2011, which was gold prices went up 10, 15, up to 30, 35% per annum every single year. On average, I think they did around 15% per annum, which is, when you compound that over 10 years, it was a very significant bull market. It was interesting, when you say a raging bull market, it didn't feel like that because gold, the media was never particularly positive on gold, and it was only towards the final stage of the bull market that it became a raging bull market and the public began to participate. It was actually a stealth bull market from 2001 to 2008, 2009. So I think we'll possibly see the same thing again. I think gold will possibly eke out gains now in the next year, 2 years, 3 years, before potentially going parabolic when we have some form of financial crisis. But it very much depends. I think we are going to have a financial crisis akin to the 2008 crisis because the level of debt in the world today is actually much bigger than it was then. Global debt to GDP ratios are touching on 330%. So, in this so-called recovery, the balance sheet of the world at every single level of society in terms of, us as households and consumers, and then companies, and then corporates and financials and institutions, and then sovereigns. The debt has gone up at every strata of society, in every nation in the world, in every continent in the world, and GDP has not increased to the same degree. So while that's all fine, while we have near 0% interest rates, I think, as we know, it's only a matter of time before interest rates start moving higher, and we're beginning to see that in terms of central banks. But more importantly, we're beginning to see that in terms of the bond market, and the US 10-year has gone up to 3.10%, and there's a lot of concerns that the massive bull market that we've seen in bonds for the last, since 1980, we've seen a bull market in bonds, that may be coming to an end, and we may see a bear market in bonds. And if we see a bear market in bonds, then obviously the bond prices go lower and the yields go higher. And I think that's a real possibility in the coming months and years. So that sort of environment, sometimes you read in the mainstream media that, rising interest rates are negative for gold. And that's actually not accurate. Rising interest rates are actually positive for gold, because rising interest rates are more negative for property in particular, because there's a huge amount of leverage and debt involved in investing in property, whereas with gold, no one borrows money to buy gold. So gold tends to do well in a rising interest rate environment, as was seen clearly in the 1970s. It tends to do poorly in a declining interest rate environment, which was seen in the 1980s and 1990s. And where gold becomes vulnerable is actually only towards the end of an interest rate tightening cycle. So there's a degree of truth in it, but gold is not rising interest rates are not necessarily negative for gold. It's only towards the end of an interest rate tightening cycle, when investors and savers are rewarded with a decent yield on their investments. That's when gold becomes vulnerable, and that was seen obviously in the late 1970s, when interest rates had to go over 15%, to burst the gold bull market at the end of that decade.
That is so interesting. Now, Mark, should people understand that gold is insurance and not an asset that enriches the individual? In other words, should the animal spirits which prevailed in the post-2008 era be tamed?
Well, yeah, I mean, animal spirits are a good thing, but it's like with investing, it's important you don't let them get out of control, and we have to control these emotions in terms of greed and fear, and gold has a bit of both, actually. More recently, it's more about fear, and as I said before, the people who are buying gold are not about return per se; they're more about wealth preservation. And as you said, that's what gold's value is. It's a form of insurance against these risks that are in the world, So, but hopefully we will see a bit of animal spirits, and a bit of a little bit of exuberance is good. And I think that'll be good to come into the gold market, because it does encourage new buyers, because most investors are about return, and they tend to focus more on gold's price rather than gold's value, And I think, as you're alluding to there, that the gold's value is as a hedge, it's as a form of insurance. And I could tell you dozens of stories of our clients, during the financial crisis, how gold came into its own, because it was, for many people, it was the one liquid asset that they had, that they could sell, and they could use the monies to, whether it be pay down debt, repair their balance sheet, look after their children's education, healthcare needs, maybe buy another property or make another investment. So gold has it has a value in that regard, in terms of helping people with whatever they want to achieve in their lives, and in terms of their day-to-day needs, and even their medium and long-term needs. So it shouldn't be seen solely as an investment about return. It is more about its utility is as its value as a hedge and safe haven, particularly on certain economic times.
Now, Mark, In your opinion, how likely is hyperinflation?
Um, well, it depends what country you're talking about. There's a hyperinflation in Venezuela right now as we speak.
Yeah.
I think there's another one in Zimbabwe, the second hyperinflation, and
Mm.
there's quite severe inflation in many nations around the world as these currencies are devalued. So, but I presume you're asking in terms of the US and in Western markets.
I would think yes.
Yeah, yeah. I
Including
mean,
Ireland also, you know.
yeah, yeah. Well, I think in the short term, it's highly unlikely, and the amount of debt in the world creates massive deflationary pressures. And if you see deflation, then in many ways, that's the opposite of inflation. But I think where we'll see deflation, I don't think we'll see real deflation akin to the 1930s. I think what we'll see is deflation of assets, because we've seen massive inflation in the value of assets, particularly stocks and bonds, but also many property markets around the world have seen very, very significant price appreciation and inflation. So I think where you'll see deflation is with assets in particular, and anything that has a lot of debt attached to it, because it's going to be harder and harder to service these debts. So I think you'll see deflation in those assets and deflation in consumer items that also have a lot of debt attached to them and that people borrow to buy. So cars, as an example, would be another example of that. I think give yourself 3 or 5 years and you should be able to buy some second-hand cars much, much cheaper. So, but where I think you'll see inflation is in I suppose more in food, in water, in agricultural commodities, and indeed most other commodities as well. So you see deflation in debt-based assets and goods, and see inflation in, I suppose, the necessities of life. So hyperinflation doesn't look a realistic scenario in the short term or the medium term. It's possible in the longer term, because the scale of the quantitative easing that's been seen is absolutely huge, and the destruction that's been seen on the central bank's balance sheets. So the question is, when we get this next bout of deflation, and we've seen a little bit of it now in the stock markets, in particular in October, but property markets in London are falling, property markets in Sydney and Melbourne, Vancouver, a lot of these overvalued property markets are beginning to fall. So there are deflationary pressures building, and the question then becomes, what do the central banks, how do they respond to that? And I think the central banks will respond by going back to quantitative easing again, and they'll probably call it, they won't want to call it quantitative easing because we've had QE1, QE2, QE3. They won't want to call it QE4, so they probably repackage it and call it some new name. But I do think quantitative easing is quite likely. And if you get into that scenario, then and they do that for a period of time, then you do get into the potential for hyperinflation. But at this moment in time, it's a long way off. It doesn't look like it will happen in the short or medium term.
Interesting. So it's really the necessities that you're talking about as far as the hyperinflation goes.
Well, sorry, in the short and medium term, you could actually see more stagflationary pressures akin to the 1970s. And the 1970s, stocks and property in effect went sideways, assets in effect went sideways, and food and oil and energy saw massive inflation. So you could see that. But if you get a proper hyperinflation, then in effect everything goes up in that scenario, because the currency is actually collapsing. It's not that the value of anything is going up per se; it's more that the value of the purchasing power in your pocket, your pounds, your euros, your dollars are losing value. And yeah.
Now, Mark, in your opinion, when we're talking specifically about gold, do you see any supply constraints coming?
Well, there's one major supply constraint, which is Mother Nature, and we live on a small, finite planet, and people don't realize how rare gold is, and that's what makes gold a safe haven asset. So all the gold in the world, if you bring it into one giant gold bar and you refine it, make it 4 nines pure, so 24 karat pure, it's 21 meters cubed. So you would fit it on the center court of Wimbledon. Or for your American listeners, yeah, you're frowning. I mean, I remember when I first heard that statistic back in 2003, I frowned as well and said that can't be true, because gold is ubiquitous. It's everywhere. You probably have
Right.
little bits of gold on your person there, and you look around us every single day. We see little bits of gold, and people have their rings and they have their jewelry and all the rest. But most of that gold is 9 carat. So 9 carat is 37.5% pure. And most jewelry, particularly in the Western world, is 9 carat and sometimes 14 carat if you're lucky. And so it's only if you brought all that gold together and you refine it and you made a 4/9 pure that it's 21, maybe 22 meters cubed. I think it was 21 meters cubed about 6-7 years ago. We might be closer to 22 meters cubed now. So it's basically 2 Olympic-sized swimming pools. So it's very rare and it's finite. And as I said, we live in a small planet. The population plan has gone from 3-4 billion. 1950, I think it was 3 billion to 7 billion today, and the projections are for 9 billion. And more importantly, the money supply has just increased exponentially. We used to talk about, billions a few years ago were big numbers, and being a millionaire was a big number, and it was billionaires and now it's trillionaires, and people need to stop sometimes and think about it. I think even the people who work in the markets and work in finance don't comprehend how big a trillion is. It's a 1 with 12 zeros. It's 1,000 billion. It's a million. It's a huge number. And the national debt, as example of it, the US and Trump. Trump is the national debt. Love him or loathe him, and I see good and bad in Trump, and I hate the device of, it's all bad and all good. Like most people, there tends to be good and bad. But anyway, that's a separate matter. The national debt is going up at about $1 trillion per year with him. And in the same way, it went up with $1 trillion per year with Obama and roughly $1 trillion a year with Bush, George W. Bush, the second Bush presidency, So the national debt is going parabolic, and that's over 21 trillion now. And then you have unfunded liabilities of between 50 trillion and 100 trillion. And that's your Social Security, your Medicare, and your Medicaid. And those baby boomers are retiring, as we know. And I think they're retiring at the top of this economic cycle. And the only way that is going to be paid, I think, is by printing dollars in effect, because economic growth is not going to pay for it. So in that context, when you look at the very small, finite, rare gold market vis-a-vis the massive increase in the demographics in the population, and then the even bigger increase I'll just use the US as an example, but globally, I think we're heading for global debt of 200 trillion or something crazy like that, over 300%. So when it's 300% debt to GDP ratio. So that means there's 3 times more debt than there is GDP. And that's basically the global GDP. So the value of all the goods and the services in the entire world, there's 3 times more debt. So it's important to really understand this and get your head around it, because, we lose jargon and we use figures and people they don't understand what's really going on, and that's what's going on. So gold, are there supply constraints? Yes, huge supply constraints. It's a very small marketplace. And interestingly enough, we've written about, there's a lot of talk of peak gold, that you might see a Himalayan sort of peak in gold production, that the production goes up and up and up, and then it goes down sharply. We don't think that will happen, but we do think we're possibly going to see a plateau gold whereby we hit peak production and then production goes sideways for a period of time. And that's been seen internationally now, that the gold supply hasn't increased. There haven't been any big finds of big gold mines in 20 or 30 years. And production is at best flatlining globally. And it's interesting when you look at, say, the gold chart of South Africa in the basically the 20th century, from 1900 through to today. South Africa used to be the biggest producer of gold in the world. In 1970, they produced 1,000 metric tons of gold. And then last year, they produced less than 20 metric tons. So production in South Africa, gold production in South Africa, the biggest producer of gold in the world, has fallen by more than 80%. So, it's very, very,
That's a
very
big
important.
sign, isn't it?
It is, yeah. And only yesterday, as we mentioned, the Hungarian Central Bank. Hungary used to be one of the biggest producers of gold, going back hundreds of years. Hungary was a big gold mining nation, but they exhausted supplies hundreds of years ago. In most European countries, the supplies of gold exhausted. So then we went and we colonized Africa and South America and all these other nations, and South Africa became one of the biggest producers. But we haven't found any more gold. Big gold mining finds have been very rare indeed. The only bright spot has been that your Chinese production has increased, and that has actually, China now is now the biggest producer of gold, and indeed the biggest buyer of gold. So, and that's because China was a communist nation for, since 1949, and they didn't have any money being invested in gold mining exploration or indeed in gold mining itself. So it's understandable enough that China is playing catch up, but most of the world is in effect either flatlining or seeing falling production for gold. And so we do look at, even Goldman Sachs have talked about peak gold. So there are supply constraints. So all it takes is a small amount of increase in demand in the global marketplace to see a quite significant impact on the price.
Now, Mark, are you in the camp that believes that precious metals prices are being manipulated all the time? From everything you've seen, what are your thoughts on this topic?
Yeah, well, I don't know if I'm going to go as far as all the time, but yeah, I think quite frequently.
A lot?
Yeah, a lot, yeah. And I mean, the guys in GATA, Chris Powell, GATA is the GATA, Gold Antitrust Action Committee, and these guys have done a long, hard slog, done a great job over the years just looking at this and analysing this, and initially I was a little bit skeptical of it, but the more I've looked at it, I think they have amassed a lot of documentation there that strongly suggests that there is manipulation, and not only that, there are admissions by some of the central bankers themselves, including Alan Greenspan, the former Federal Reserve chairman, and indeed Eddie George, who's a former Bank of England governor. These guys have talked about the need to intervene in the gold market in order to maintain confidence in fiat currencies and in the wider financial markets. So it sort of stands to reason that these central banks and governments, one of their primary I suppose reasons of being is to maintain faith in the economy and maintain faith in the currencies. And if you have a gold price going through the roof, then people are going to not have faith in the currency, and they're going to be worried about the markets and financial markets and risk assets and pension funds and all the rest. So they want to maintain that confidence, and one way you can do that is by suppressing the gold price. And I think that's what's happened in recent months and years. And GATA have a lot of documentation, and there's actually a lot of other independent researchers who have come to this conclusion, and indeed some of the banks have actually been prosecuted, they've been found guilty, and unfortunately they tend to just get fines that sound very large indeed, but they're probably a day or 2 days profits for some of these banks. It's just like a slap on the wrist for these banks, but they have been found guilty of manipulating markets. And I think it's quite easy to do in terms of the futures market, because it's all electronic, and all you have to do is sell a few billion ounces. You're not selling ounces, you're selling notional ounces. You're selling a few $1 billion worth of gold futures contracts, and that can push the price lower in the short term. And that's been seen very frequently in months and years, and oftentimes at completely counterintuitively and completely inappropriate moments. There's been no negative gold news or no positive economic news that would account for a massive sudden fall in the gold price, and that's happened on a number of occasions, and frequently we find out afterwards that the banks were in there manipulating the price. So the question for me is more, is it purely banks doing it for their own profit motive, as banks do and hedge funds do, or is it more coordinated and concerted in terms of the central banks allowing some of these banks to do it on their behalf? And I think it's likely the latter. And I said GATA and other independent research have come to these conclusions. So people much more wiser and with more resources than us. So I think it's likely. But the bottom line is, it shouldn't put people off. Sometimes it puts people off because they think that they're don't fight the Fed, or the house always wins. Don't the casino always wins. But I think that's wrong. I think the casino is very powerful indeed, and the house is very powerful indeed. But I think ultimately what they're doing is they're creating a completely artificial marketplace whereby they're artificially suppressing the price. But ultimately, I'm a great believer in natural law, and that the fundamentals of supply and demand will dictate the price over the medium and long term. And in the short term, they can affect sentiment. sentiment in a big way, and they can depress sentiment and they can depress prices. But ultimately, supply demand that will dictate the price, and that was seen clearly from in the last bull market up to 2011, 2012. So they're not all powerful. Sometimes I think, the market demand overcomes the manipulation. I think that will be seen again, and we liken it to it's like a giant beach ball that's been pushed down to the bottom of this very deep swimming pool, and the more you push that beach ball down, the more ultimately it jumps out of the water.
It's gonna pop.
Yeah, exactly. The question is when, exactly.
They're sort of creating a buying opportunity in a way, aren't they? By suppressing prices.
Yeah, absolutely. Because unfortunately, what we see with our clients is they tend to buy when the gold price has gone up, and when gold hits 6-month highs, 12-month highs, and it gets in the record, it's in the headlines. People go, "Oh, I meant to buy gold a few months ago, and I didn't because I was nervous it was going to go lower, and I better do it now before it goes higher." And then invariably it starts to fall straight after they buy. Yeah, exactly. So they don't understand you buy in weakness and buy in dips. So, manipulation actually feeds into that, that they're actually artificially creating value for buyers, and creating opportunities for people. So, but do buy on the dips is what we always suggest,
Yes. Now, Mark, it's been so wonderful to have you on this show. Please talk about your company, Gold Core, and also please share with us the details about Direct Access Gold.
Yeah, well, thanks for having me on, Michelle. I've enjoyed the conversation. And as you said at the top, basically we are bullion dealers. We specialize very much on the physical side of things. So gold and silver coins and bars for delivery internationally. And then what we really specialize in is secure storage and allowing people to own gold in the safest vaults, in the safest jurisdictions in the world. And most of our clients store in Zurich, would be the favorite, Singapore, Hong Kong, and London. And we're soon opening more vaulting jurisdictions due to client demand, actually. So we're going to open up in Dublin, Ireland for the first time. We're opening up in New Zealand, in Toronto, in Cayman Islands, and I think Dubai as well. So we'll have one in the Middle East there. So and we basically work with Loomis and Brinks will be the two big storage providers we work with, and we believe they're the two safest in the world. We've been in most of the vaults around the world and done our due diligence. So they're our vaulting partners, and basically we specialize in allocated and segregated gold. So the clients have outright legal ownership of the gold and silver coins. They can take delivery at any time. They can go and visit the vaults, visit their gold, inspect it. It's not commingled, so we don't have all the clients' gold in one giant or 10 giant pallets. They are actually separate from everybody else, and that's quite unusual. Most of the other dealers and most of our competitors actually, sometimes it's they say it's allocated and segregated, but it's not actually segregated because they are all co-mingled, and it's a form of pool gold. A lot of the digital gold platforms and indeed the ETFs. So we believe this is the safest way to own gold, and we believe gold is a safe haven asset, but it's only a safe haven asset if you own it in a very safe way. So that's very, very much what we specialize in. And we just launched Direct Access Gold. It's again very much client driven. So there are a new set of risks that we're becoming more aware of in recent weeks and months. And that is, I suppose, the cyber risk and the systemic risk, and with all the wonderful technologies that we have today, and we're all embracing digital technologies and all the rest, and it is wonderful, and it creates huge opportunities, but it also creates risks for people, and we do think that, if you have your gold and you own it through a digital gold platform, and the only way you can actually access your gold and buy and sell your gold is through that one website, then we think that creates a degree of risk, unappreciated degree of risk, and there have been instances of, obviously, there's hacking, there's cyber terror, there's cyber war, there's internet shutdowns, there's vulnerabilities in electrical grid. So what we've set up with Direct Access Gold is whereby these very worst case scenarios, we call it AAA. It's available, actionable, and accessible, available, accessible, and actionable. And what that means is you have liquidity at all times, and no matter what. So if you kind of contact us because our websites are down, our phones are down, a nuclear bomb goes off in London or Dublin, so all these worst case scenarios, which we don't think will happen, but we have to acknowledge there is a small chance it will happen. It's a bit like your insurance that you have for your car. That's 1 in a 100,000 or 1 million chance you're going to have a car crash, but you have that insurance just in case. So how we set this up now is whereby there's a contingency agreement between the client, the vault provider, and ourselves. And if for any reason they cannot contact us for a short period of time, then they can go directly to the vault provider and say, I cannot access Goldcore for XYZ reason, and I want to take delivery of my gold, or I want you to ship my gold to the United States of America to this address, or I want you to move my gold to a third-party provider. So it's yeah, as I said, it's very much client-driven. It's us going to the nth degree. We're already very, very safe in terms of the secure storage we offer, but we wanted to go one step further because some certain clients want that, and for that they'll pay us a slight, basically it's 10 extra basis points per annum on the storage fee, and but we think it's worth it if you are, you know, a very risk-averse gold buyer. Then this is absolutely something that you should explore, and I think you'll see the benefits in it.
That's wonderful. Now, how can our listeners find out more about your products, get in touch with you, and follow your work?
Yeah, well, so it's all the usual channels. The website is goldcore.com, goldcore.com. And yeah, we're on all the usual social media channels, and we're doing more and more YouTube videos like yourself. So we're quite big and increasingly on that medium, but we're on Facebook and Twitter, and a big thing we do is a daily and a weekly market update. So if you're interested in hearing more about what we do, you can actually subscribe for that on our homepage, and you can get the daily and weekly updates, and indeed the video updates as well. And yeah, if you have any questions at all, just feel free to give us a call or shoot us over an email, and we'll endeavor to answer any questions that you might have and help you open up an account.
Mark, thank you so much for joining us today. It's been amazing to have you on the show.
Absolute pleasure, Michelle. Thank you.
Mr. Mark O'Byrne, the founder of goldcore.com. For the leaders of tomorrow's show, I'm Michelle Holliday at portfoliowealthglobal.com.
Silver Bull, the famous Chris Dwayne, who mints his own coins, discusses triple-digit silver prices. Vortex, breaking down how the end of the crypto bear market will catapult Bitcoin to new, fresh, all-time highs. Jim Rogers outlines exactly how the crash will happen, and Charles Nenner on major stock market crashes and gold crashes. Portfolio Wealth Global continues to pound the table that this bull market is not over in stocks. In fact, Starbucks, our latest stock profile, jumped from $51 to over $63 in no time, as it opens a new China branch every 15 hours. Make sure to subscribe to the newsletter as we reveal our picks for 2019.